Rich, let me bring you in on this as well, just from an interest rate perspective.
Yeah.
You, of course, authored something earlier this year about the term premium.
Yeah.
So we'll just get your thoughts on the fiscal situation that Libby outlined and how investors should be thinking about it from a rates market perspective.
Sure. And first of all, what is the term premium? It's easier to describe than measure, but it's the compensation that bond investors earn for taking on interest rate risk. So in general, if you take on risk, you want to be paid for it. And historically, bond investors have been paid in a term premium with a higher return on, say, a 10-year treasury than a T-bill. And in particular, term premium are driven by a lot of factors, including global developments and the like. But one factor is debt and deficits. And I think what we have argued here and what we're starting to see in the data, and I made reference to this in the piece that you mentioned, is markets aren't blind to this. Markets have already started to price in, we believe, a term premium, whether or not you're looking at real yields on inflation index bonds or other indications. A lot of the repricing that we've seen in the last couple of years, remember 10-year treasury yields got down below 1% at one point. And so, yes, it's been a big move up, but really what was abnormal was the 1% 10-year treasury yield, not the 4.5% treasury yield that we see now. So we do think, and this is a core thesis of ours, that going forward, bond investors will earn that term premium, and in particular as the yield curve gets steeper. And so we're in a very unusual period now where we've had this inverted yield curve for going on 2 years. That's not the new normal. The curve will not be inverted forever. It will re-steepen, and when it does, that's going to be a positive for bond investors as well.